Hey, fellow investors. Today we will take a look into the stocks being targeted by the biggest tech companies. Recently, Nvidia purchased 6 stocks, with the chipmaker spending hundreds of millions of dollars in ownership stakes as high as 8% in these companies. Those stocks are up an average of 64% in the last 6 months as the companies grow to their potential. But that is nothing compared to what I found when I followed the money. Amazon is spending over $2.2 billion buying shares in 10 companies. In fact, Amazon has over $1.7 billion in a single company and owns almost 16% of the total shares issued. I'll reveal all 10 stocks Amazon is buying, along with 7 stocks to watch and how to use these insider reports in your own stock research. The first stock Amazon is buying is also its largest ownership stake, Air Transport Services Group, ticker atsg. Amazon owns 12.7 million shares, worth almost $280 million, representing almost 20% of the total company. Air Transport offers a complete air leasing and support service to blue-chip companies, including passenger and freight operations, aircraft leasing, maintenance, and servicing. However, this investment is likely different for Amazon compared to some of the others on the list. This one isn't aimed at generating a big return or gaining exposure to fast-growing technology. Instead, it is a strategic investment. With its major controlling interest in ATSG, Amazon has a key partner in its freight delivery operations, with air transport providing and leasing planes to the company. ATSG isn't a fast-growing company, with revenue down slightly this year and expected to rise just 4% next year to $2.1 billion in sales. It's also not terrifically cheap at 20 times the expected earnings. However, it does have a very dependable cash flow due to its tie-up with Amazon. It's possible this company could become a takeover target for Amazon in the future, so there is some upside potential. While the revenue growth is dependable, this isn't a high-growth stock like some others on the list. We're just getting started with our list of stocks Amazon is buying, but the only thing better than following these tech giants into publicly traded stocks is buying in before the market does. This is how Peter Thiel made over 4,000%, 40 times his money, as an early investor in Facebook, and how Elon Musk made his first billion with PayPal. Next on the list is Era Labs, ticker ALAB. It just went public in April of this year. It is already up 86% on the boom in AI stocks. Amazon owns over 277,000 shares of the company, a relatively low stake of just 0.17%, worth $27 million. Even at a very expensive valuation, as we'll see later, Era may be one of the best ideas on the list. The company offers connectivity and networking solutions, which, while so far have gone under the radar in the AI boom, could be the next big bottleneck in artificial intelligence. That's because the immense amount of data and processing going on in these AI models is going to stress the current system for connectivity and networking. Only companies like Era, specifically built for that higher demand in AI, will be able to provide the solutions. Revenue is expected to grow 60% next year to $615 million, with earnings already positive and expected to hit $1.17 a share. But this is still a tiny company on its financials. Well, tiny until you consider the valuation. Even on that expected revenue and earnings, shares are trading for 27 times sales and 82 times on a price-to-earnings basis. Now, that is terrifically expensive, so if you are buying these shares, I would advise you to hold back some money in case we see better prices. But the company's position in the data center connectivity and networking theme should mean it grows into that valuation over the long term and produces solid returns. IonQ, ticker IONQ, could be the next big theme after artificial intelligence, the speed of quantum computing. Amazon owns just over 1.9 million shares here, worth $57 million, almost 1% ownership of the company. Already, we see Amazon making much bigger investments than Nvidia did in its stocks, investing tens of millions and even billions in stocks we'll discuss later. Amazon is investing for different reasons, though. While most of Nvidia's investments seem to be geared towards nurturing companies in the AI space, those that would buy Nvidia chips, Amazon is taking a broader view and investing across next-generation technologies. IonQ is positioning itself to be a leader in quantum computing, the next generation of processing speed, in a market it estimates could be worth as much as $850 billion by 2040, across everything from AI to cryptography. For a long time, it seems as nothing more than fantasy. Quantum computing uses the laws of quantum mechanics to solve problems too complex for even the most advanced computers today. It offers computing power that could be 100 million times faster than a regular chip. Of course, we're still extremely early in this technology, and even a leader like IonQ isn't quite there yet, though it does have some smaller scale products out. While revenue is expected to surge 88% this year and 99% next year, it's only at $83 million in sales. So this investment is very much ahead of its time. Again, here we see almost comically expensive valuations on the stock. It's still posting negative earnings, so there's no PE ratio, but on a price-to-sales basis, it's at 79 times even next year's expected revenue. Still, that might not matter when quantum computing becomes a reality, as this could become a $100 billion company at that point. But it's also likely further out than even the upside in Era Labs. Maybe dip your toe in now, but put this one on your radar for later. We've still got 4 Amazon stocks to highlight, but remember, we know the company is buying these because every company or large institutional investor is required to file a Form 13F with the Securities and Exchange Commission, SEC, disclosing their investments in publicly traded stocks. That disclosure is meant to help the SEC head off any possible stock price manipulation by big hedge funds and other major players, but it can also be used by investors to jump in on these investments ahead of an acquisition or just a bump in share price. You can always find these 13F filings by going to the SEC's EDGAR database, searching for the company name, and clicking through to the most recent 13F report, a list of those investments. Now, understand there are different reasons a company might buy shares in another, and it could mean a difference in returns for investors. For example, in the case of Nvidia buying shares of ARM, it's getting a say in the shares of a major supplier. ARM licenses the architecture that goes into semiconductors, so it's a critical component for not just Nvidia, but also Intel and AMD. Nvidia was blocked by the FTC from buying the company outright, but an investment gives it a spot at the table. A company may also be interested in a future takeover of another, and want to get its foot in the door with a large block of shares to ward off rival buyers. This is likely the case with Amazon and its ownership of Air Transport Group, with nearly a fifth of the company. Then there's also just the good old return driver for investments. Companies like Amazon and Nvidia are cash machines, generating tens of billions of dollars in cash each year. At times, they run out of projects to reinvest that money into within their company, so they look for stocks to buy. You'll notice in all these stocks, or in the Nvidia video, that the buyers have inside information into their sectors. They know which companies are going to do best, and they're investing in them. But as we say here on the channel, it ain't all rainbows and unicorns. There's a warning to using these 13F reports to invest. First, companies have 45 days after the quarter ends to report these to the SEC, so there's a big lag in the investment. Most of these stocks are held long-term, so it's not a matter of Amazon buying them and then dumping them for a quick return. But understand there is a lag to that reporting. Also, you'll often see these stocks jump when the 13F is reported and then give up some of those gains in the months following. I always recommend using these 13F filings as a heads up to find stocks to start your research. If it looks like a good buy, maybe invest some right away, but leave some cash aside to invest if the price comes down later. For example, shares of SoundHound AI jumped nearly 70% in February when Nvidia reported its stake in the company. The stock surged another 133% over the next month as investors rushed in, but enthusiasm died down quickly after. For patient investors, though, the stock has jumped back up again as that growth theme plays out, with shares up 274% this year alone. But not like the tech stocks that we've seen. Looking at the full list of Amazon stock investments, all 10 companies it reports a stake in, you'll notice I didn't cover 3 of them: Nautilus Biotechnology, Outset Inc., and SmartRent Incorporated. All 3 of these are very small companies, and with the exception of Outset, don't look like they're producing the kind of growth they need. More than anything, it was really the cash flow situation. For example, looking at the cash flow statement for Nautilus, we see increasingly negative cash flow from both operations and free cash flow. We also see an in-cash position that leaves the company in jeopardy of not being able to continue. That cash position is important for any company, but even more so for these smaller startup-like companies. Folks, cash is like oxygen for these. With it, they can breathe and hold out while that growth improves cash flow. Without it, they're going to suffocate and die. So it's one of the first things I look for when investing.